Good evening, everyone. I'm John McGreevy, Dean of the College of Arts and Letters, and I'd like to welcome you all to the inaugural Theodore and Rita Combs Distinguished Lecture in Economics. We are very pleased to welcome as our speaker this evening James Bullard, President and CEO of the St. Louis Federal Reserve. Before I introduce you to President Bullard, I'd like to offer our sincere thanks to Ann Combs, a Notre Dame graduate of the Department of Economics and the Department of Government from the class of 1978, whose generosity has funded this lecture series in honor of her parents, Theodore and Rita Combs, who believed in the power of education and who also loved Notre Dame. Ann couldn't be here this evening, but Ann's sister, Susan Combs Demphier, and her husband, John, are with us in the audience, and we thank them as well for their presence here tonight. Please join me in thanking Ann in absentia and the Combs family for their support of economics and the intellectual life of our faculty and students. I am particularly proud to inaugurate this lecture series tonight because the event highlights our economics department to the Notre Dame community. Economics has experienced exciting growth over the last few years. We've dramatically increased our faculty with very distinguished hires at both the senior and junior level, and our goal over the next several years is to effectively double the size of the faculty. The major is the fastest growing in the College of Arts and Letters, tripling in the last 10 years, and this year we've inaugurated a new major, International Economics, that trains students in both the principles of economics and advanced language acquisition in preparation for careers in international business. One of our faculty, Joe Koboski, just won the Frisch Award for the best article in econometrics, one of the most prestigious awards in the discipline. President Bullard's presence here tonight only adds to our excitement about economics at Notre Dame. Bullard received his doctorate in economics from Indiana University in Bloomington. He holds Bachelor of Science degrees in economics and quantitative methods from St. Cloud University in St. Cloud, Minnesota. President Bullard is President and Chief Executive Officer of the Federal Reserve Bank of St. Louis, one of 12 regional Federal Reserve banks across the nation. He has been president since 2008, a period that must rank among the most important and challenging, I won't use the term exciting, in American economic history. As president, he participates in the Federal Open Market Committee meeting with Federal Reserve Chairman Ben Bernanke and relies on the advice of the bank's Director of Research, Professor Chris Waller, a full-time member of our faculty until he moved to St. Louis, and someone so dedicated to Notre Dame that he flies up to teach one class each fall, mysteriously arranging his class to be timed on the Fridays before football weekends. An economist and monetary scholar, President Bullard has been with the bank since 1990. His research has appeared in numerous professional journals, including the American Economic Review and the Journal of Monetary Economics. Beyond the Fed, Bullard is an honorary professor of economics at Washington University in St. Louis, where he also sits on the advisory councils of the Economics Department and the Olin Business School's Center for Finance and Accounting Research. Please join me in welcoming our inaugural Theodore and Rita Combs lecturer, President Jim Bullard. Thanks.
Thanks very much, and thanks for that kind introduction. It's a pleasure to be here at Notre Dame, and I'm really looking forward to giving this lecture and warming you guys up for football weekend here. We've got, I see you wanted to start your evening right by getting some macroeconomics in before you get going on other things. And that is exactly what you're going to get. I'm going to talk macroeconomics here. We will have some Q&A at the end. I'm not going to talk that directly about current policy, but you'll see some reference to some issues in monetary policy. So feel free to, come up with your questions later. I can't cover everything in one lecture. Let me just jump in here. This is going to be about the recent experience in monetary policy. And hopefully I'm going to do it in a way that sort of juxtaposes between frontier research and maybe somebody that doesn't have very much background at all. So you can tell me if I can do a good job with this or not. But the basic idea in the U.S. economy, if you don't follow it very closely, I know some of you students maybe don't. The main idea is there was a huge shock in the U.S. economy in 2008 and 2009. And I'll show you a picture of how big that shock really was. And the main question is, suppose policymakers like me and Chairman Bernanke and the Federal Open Market Committee, which is the main policy-making arm of the Federal Reserve, suppose we had done the right thing, just reacting in just the right way. What would have happened? What should have happened? And I'm going to give you an idea about how to think about that question and how to look at that question. So the answer that comes from some of the literature in macroeconomics is that the FOMC, that's Federal Open Market Committee, should have maintained the aggregate price level on an established path. And I'll show you some pictures of that and what I mean by that. So the so-called price level targeting can be the optimal monetary policy according to some leading theories. So I'll tell you a little bit about theories in macroeconomics. So here's the way it is. There's 100 theories on the table. Each theory has a little bit of truth attached to it. The leading theory has 10% of the probability that it's the true theory attached to it. The other 99 theories have less than 10% attached to them. That's the world of macroeconomics that we live in. So it's not like, when I say a leading theory, it's not like the thing's a slam dunk or anything. It's just that it's got the most, in the pool. All right, so this is going to be the main idea here. We're going to talk about this. I'm going to try out my gizmo here. We're going to talk about this price level targeting idea. Okay, and I'll show you a picture. So even if you don't know what this is, you'll see it in pictures here. So the achievement of recent monetary policy is that, in fact, the price level has been on an established path, and I'll talk about that quite a bit. So in a sense, as far as what we were supposed to do about that big shock in 2008 and 2009, what we did looks pretty close to optimal. That's the story I'm going to be telling, because the price level path looks like it's right on target. This is true even though the committee never said that that's what we were doing. The committee never came out and said we're price level targeting. But if you look at the results, looks like we kind of were price level targeting in the end. What the committee actually did was kept inflation close to 2%, even when the economy was hit with a really big shock. So this is going to be the singular achievement, and I'll come back to this as we go through the talk here. You guys got your questions ready? Now, after the big shock hit since 2008, and it has been a while, let me remind you, we're coming up on 4 years here. We are at 4 years since the Lehman AIG episode. So as you look at other variables, other macroeconomic variables, and especially real GDP, gross domestic product, our best measure of total output and total income in the economy, that's growing along a different path than what we saw before the recession hit. So before the recession, it was kind of a little bit faster growth, higher level. After, it's been lower level, slower growth. That's what everybody's complaining about the U.S. economy. I've got a picture of that too, you'll see. So one thing about this path before the big shock hit, seems like it was a bubble. Everyone says it was a bubble. People say it was a housing bubble. Housing prices are down 30% in the U.S. That doesn't look, they are up a little bit recently, but it doesn't really look like they're going back to where they were. Mortgage debt in the U.S. is astonishing. It used to be the loan-to-value ratio among U.S. homeowners was about 60%. Now the loan-to-value ratio in the U.S. is 90%, 95%. If homeowners wanted to get back to that lower level, that 60% level, they'd have to pay off $3.7 trillion worth of debt. That's about a quarter of a year's GDP, quarter of a year's income. That's a big number. Of course, it would help if the housing prices would go back up again, but those were bubble-level prices, so that's probably not going to happen. So this path that we were on before the crisis hit was probably bubble-induced. And we got a big financial crisis. And if you want to do some reading before the football game, or during the football game, if you want, you can read Carmen Reinhart and Ken Rogoff, This Time is Different. So it's an excellent book. And what they did was look at 800 years of financial crises. 800 years of financial crises, across countries, across time. And their main conclusion, I'll save you the bother of reading it. I'll give you the one-sentence summary. Post-financial crisis economies grow more slowly. That's what they say. Post-crisis economies grow more slowly. So that is kind of what's happening in the U.S. So it looks like Reinhart and Rogoff are onto something here. And I'm going to lean on that in this talk. So what are the implications for future monetary policy? Some people have been telling the FOMC that we should adopt so-called nominal GDP targeting. Nominal GDP targeting. Nominal GDP is the price level multiplied by the real value of output. Put those two together, you get nominal GDP. You get the amount of output expressed in today's dollars, not inflation adjusted. Nominal GDP targeting is sort of like price level targeting, so it has some appeal from that perspective. You'd sort of be getting some of the same benefits that you'd get from price level targeting, which, as I'm going to show you, is optimal according to some leading theories. But my argument is that, in effect, the Fed's already price level targeting. So why go to something second best if you're already doing the first best? That's one argument. And maybe the main thing I'm going to get at toward the end of the talk here is that attempting to target nominal GDP without making an adjustment for the Reinhart-Rogoff thing that's going on is going to lead to disaster. That could lead to disaster. So I'm worried about that. And that's what I'm going to talk about. So doesn't that get you revved up? These are exciting things. This is about as exciting as it gets in macroeconomics. So I promised that I would show you a picture of this shock. And I know probably all of you don't memorize the data the way we memorize the data. But let me just tell you, it was big. So what I'm going to show you is a picture of the amount of financial stress in the economy. And in St. Louis, we have an index called the St. Louis Financial Stress Index. We're very inventive with our names in St. Louis. And what this does is it puts lots of different measures of financial stress together into one number, so you can just look at it. And some of the things that people talk about when they talk about financial stress are spreads between rates of interest on U.S. Treasuries versus rates of interest on BBB borrowers and things like this. So if you were really nervous about the economy, you might lend to the government at a low rate, but you'd be very suspect about lending to a company that only had a BBB rating or a junk rating. There's also volatility indexes about how much volatility there is in financial markets. One of the most famous ones is the VIX index, so that's in there too, and lots of other things. Put it all in the pot, stir it around, you get the St. Louis Fed Financial Stress Index. So the index, the pictures on the next slide here, is going to show that financial stress was extremely high in late 2008 and early 2009. So on this scale here, normal would be 0, and then sort of one or minus 1 would be sort of one standard deviation up above or below the normal level of financial stress. 2 would be kind of a big number. But here's what happened during the financial crisis. Here's 0, so this is the normal level of financial stress. This is going from 2007 here up to the present. And here's 0, here's 2, that would be kind of a big number, but this thing went way up, 4 or 5. So this is like off the charts amount of financial stress. Certain markets just broke down completely. So it was a big shock, that's all I'm trying to tell you. Some of the events that have happened recently, you might have read about in the newspaper, or not. European sovereign debt crisis has been a huge deal. It's been in the news so much, you might be sick of it. Greece and so on. That crisis heated up during May and April of 2010, and again last fall, August, September, October of 2011. But look at these things were kind of nothing compared to what the big shock. Okay, that's all I'm going to say about the shock. It was big. Now, I'm going to talk for a minute here about price level targeting and the notion that price level targeting would be optimal. And even if you don't really know anything whatsoever about macroeconomics, I'll show you a picture that will kind of illustrate what I'm talking about. So Michael Woodford is a fantastic macroeconomist. He's at Columbia University, and he's worked a lot on monetary policy at the frontier of macroeconomics. And he's got lots of ideas. He's got a famous book out in 2003, Interest and Prices, certainly a landmark book. If you want to read that one, you should allow some time. It's a good book. But the main thing in the book is that prices are sticky. So sticky just means that all these prices that you see every day for your coffee and the gum that you buy and the sweatshirts that you buy and the other things that you're buying, those aren't quite the right prices because they don't adjust rapidly enough to really accommodate all the changing supply and demand conditions that are going on in the economy. So the prices are sticky. That's the problem in the economy. And then the way the theory works is that optimal monetary policy, our guys and Chairman Bernanke can kind of correct for this deficiency. So we can ride to the rescue because the prices are sticky. That's the story. If the prices weren't sticky, here's a little bit of economic intuition for you. If the prices weren't sticky, they'd be clearing the markets all the time. You'd get the optimal allocation of resources. Everybody be as happy as they can be because the markets would be clearing all the time and it'd be done. Okay, so you got to have, something has to be sort of wrong with the economy to have the policy makers coming in. And what Woodford's got is the sticky price assumption. So the economy's hit by a shock. What happens in this model, this is all you're going to learn about this model, 3 bullet points. What happens in the model is that the optimal policy returns the price level back to its previous path. So I'm going to show you this in figure 1. On the left, so just to get this conceptually in your head, what's going on? You've got an economy, all the variables are at their normal levels. Then the shock comes. It's like throwing a rock into the pond. And everything gets knocked off of where it would normally be, but everything nevertheless comes back to the steady state. So in this picture, 0 is going to refer to the normal level. And Woodford has figured out, in this very simple case, a completely optimal monetary policy, And we're going to look at his picture. This is figure 1 out of like 100 figures, but it's figure 1. And you can see what these are. This is inflation. Here's output. In macroeconomics, this always means inflation-adjusted output or real output. And here's the price level. And here's 0 on all these scales. And here's a policy we're not going to talk about, the dotted line. And here's the solid line, which is under the fully optimal policy. This is as good as the monetary policymaker could possibly do in this world, in this made-up world here. So inflation gets knocked off, goes below normal, comes back, eventually goes back, all the way back to normal. This is all under the optimal policy. Output falls in this particular example, but comes back. And here's the one I want to point out. The price level gets knocked off of its optimal or its normal path, but it eventually comes back. Okay, so I'm going to focus on this one. This is the notion that under fully optimal monetary policy, the price level will come back to its previously established path. So you might think of this behavior of the aggregate price level as giving us a sort of a signature of an optimal monetary policy, So some of you might have studied physics, And they'll talk about having the pool, and the particle comes through the pool, and the particle leaves a certain pattern in the pool. That's how you know the particle came through the pool. So it's the same kind of thing here. You've got a signature of optimal monetary policy. Well, what's the data say? Forget the theory. We don't need any more stinking theory. Let's see what the data has to say about this. So the model can be giving good advice. It's a simple model, but it could be giving good advice on this price level question. And the advice is that policymakers should take care to keep the price level on an established path when the large shock hits the economy. So, has the U.S. price level remained on a path? And the answer is it has. So this picture goes from did I skip something here? Oh, yes. You got to say, well, what do you mean by a path? If you're going to look at the data, you got to draw the path starting at some point. And what I'm going to argue on this is that during the mid-1990s, for those of you that know your economic history, we finally got the inflation problem in the U.S. under control. So if you don't know anything about macro history, it's basically this. The 70s was bad, really high and volatile inflation. 80s, inflation was coming down. By the time you got to the mid-90s, you finally got consistently inflation rates around 2%, which is our current target. So I'm going to take the mid-90s as the starting point because that's when the Open Market Committee started to establish 2% as the norm for inflation in the U.S. So we'll take the 1995 price level. Let's suppose inflation increased 2% from there. Is the actual price level close to that? And the answer is yes. So here's January 1995 up to the present. Here we just say, suppose we were on this price level path that seems like a reasonable one. Here's the actual price level. We're pretty close. We're pretty close. So the answer is, as far as the signature that comes out of the standard monetary policy framework in Woodford, looks like we're right on target. We're very close to the optimal monetary policy. You might wonder what this point is here. That was right before the crisis. Commodity prices went up a lot. You might remember that, and they all dropped. So, taken at face value, this suggests that the basic advice from the Woodford framework has actually been implemented in the U.S., despite the fact that this gigantic shock hit the economy, didn't knock the price level off the price level path. So you could interpret this, if you're being charitable to us policymaker types, you could say, monetary policy has done exactly what it was supposed to do in response to the large shock, kept the price level on the price level path. So this is the singular achievement in the title of the talk. I was going to make the title of the talk Should Ben Bernanke be on Mount Rushmore? But I decided that was a little too much. So I decided to keep it like this. All right. Could it be that this was kind of doctored up? Could it be that maybe it looks like the price level is on the path, but it was really not? I don't think so. If you look at some other countries, when they miss big time. And one is that everyone kind of knows about, if you know a little macroeconomics, is Japan. So again, for Japan, the starting point would matter, but let's take the 2.5% inflation rate that prevailed in Japan in the late 80s, or all during the 80s and the early 1990s, and let's suppose that that's the target price level path. Did they stay on that path? No. They're off by a mile, right? So here's 1980. Here's up to 2012. In the 80s, everyone was saying Japanese economy was going to become the number one economy in the world. Here's the projected path. But here's what happened. They came way off this path. So this is 60, 70% off this distance here. So they're way off. Okay. So they don't meet this signature test that would come from the policy literature. I'm not going to talk a lot more about Japan. We could talk a lot more, but I'm not going to do it. I just wanted to show that when countries miss, they miss big time. And So it's really a big contrast to the U.S. where we're right on target. All right, let's get to this Reinhart-Rogoff effect. So when the policymaker tries to keep the price level on the price level path, what that does is it allows the real amount of goods and services in the economy to adjust as well as it can adjust to the big shock that occurred. The households in the model, in the model that I showed you earlier, the households would actually vote for this policy. This is the absolute best policy that they could want. There is no other policy that's better. That's why it's the optimal policy. But what if this shock was so large and so unusual that it caused especially severe damage to the economy? Especially severe damage. And if you look at that picture, the first picture I showed you about the size of this shock, certainly seems like this one might be a candidate for having caused some severe damage. So in their book, Reinhart and Rogoff, 800 Years of Financial Crises, warn that the aftermath of a financial crisis tends to be marked by many years of slower than normal growth. And in fact, a version of this seems to have happened in the U.S. As I was explaining earlier, before 2007, you probably saw growth that was artificially high because of the housing bubble. And it's not just building the houses. It's all the ancillary industries that are feeding into the housing boom. So the guys are trucking the materials to the home sites. They're getting paid off this. You've got suppliers of the raw materials. They're feeding into this. You've got you've got real estate agents. They're feeding into this. So you've got a whole industry that's lumped on. It's not just the guy who's shingling the house. And after 2009, we've got all this extra debt in the economy because of the housing collapse of the housing bubble. What's happening is people are so-called deleveraging. This means they've got too much debt and they have to pay it off. As students, you guys will be very familiar with this. This means you can't go out and have a beer because you have to pay off the debt that you ran up in the past. And that is definitely happening in spades in the U.S. People have built up too high of a debt, therefore they don't want to borrow anymore, they want to pay down their past debt, they don't want to buy a new car, they don't want to buy a new house, they don't want to buy new anything, they want to pay off their past debt. So that's the deleveraging. So the U.S.'s growth has likely been slowed by deleveraging. It was likely artificially high before the crisis. And here's the picture. This is real GDP. This is inflation-adjusted GDP. This is the real value of goods and services that you and I get to eat every year. This goes from March of 2003 up to the present, and this is in billions of 2005 dollars, so this means it's been adjusted for inflation, and this thing was growing about 2.8% from 2003 to 2007. Then you had this crisis period. Since then, we've been growing at 2.2%, and we're at this lower level. So if we grow at 2.2%, we are never going to get back on this path. This path is going way up here. We're way below that path. But Reinhart and Rogoff have a story for this. Their story is, hey, we looked at all these financial crises around the world. This was a financial crisis in here, and this kind of thing happens all the time. That was their story. Also, with employment, maybe even more dramatic, here's total non-farm payroll employees in the United States, around 138 million at the peak. This thing was growing at about 130,000 a month from 2003 to 2007. You had a big drop-off during the crisis. Since then, it's been growing at about 74,000 and doesn't look like it's ever going to get back on that path. So this is bugging people in the U.S., as it should. It's very disturbing. So the Reinhart and Rogoff hypothesis seems to have at least some validity for the U.S. during the last several years. And if you don't believe the U.S. example, you might look around the world like Reinhart and Rogoff did. The Swedish experience is one that's particularly useful. Sweden's had a major financial crisis in the early 1990s. Their policy response is often taken as a model. They took over the banks, they kicked out the management, they put in new banks. So they were especially aggressive, and many people think especially sensible about handling their financial crisis. But their employment levels never returned to the pre-crisis trend. So here we are for Sweden. This is 1969 now up to the present. Here's their crisis in the early 1990s. I think it's about 1990, 1991. Here's the employment path in Sweden before the crisis. Then the crisis came, just like the U.S. There's a huge drop-off. And all the years since the early 1990s, they've never really gotten back up to that trend. So it's true in at least one other country, but Reinhart-Rogoff showed you many other countries. All right, so what? You might say that's always a good question for a student to ask. So what? What if you don't adjust for this Reinhart-Rogoff effect? You just say, I don't want to think about that. I just want to think about the fact that real GDP is way lower than it used to be. Well, for this nominal GDP targeting, nominal GDP includes both the price level and real GDP. It puts them together, multiplies them together, does not separate the two. And I've argued already that the price level seems to be right on target. So in that sense, monetary policy did exactly what it was supposed to do, but real GDP is way off. So this seems to have been markedly influenced by the Reinhart-Rogoff effect. So us central bankers get together every year at Jackson Hole, Wyoming. Actually, it's not just U.S., it's central bankers from all around the world. And we have a conference, and at that conference, our own Professor Woodford, that I was referring to earlier, was actually at the conference. And he used the following chart, a version, really. He didn't use exactly this chart, a version of this chart on nominal GDP. He drew this picture here. So here we go. This is from March 2003 up to the present. This is nominal GDP now, so this is just the dollar value, including the inflation in there, of the goods and services in the United States. And here's the path from 2003 to 2007, and nominal GDP is way below this. So if you're a nominal GDP targeter, what you're saying is, hey, I think Fed should get this thing back up to this thing. Wait a minute. This is not being adjusted for the Reinhart-Rogoff effect. You've got to adjust. You can't just say we need to get up there, because it's really the optimal policy is the price level targeting. I already told you that price level is on target. So based on this picture alone, one might conclude that U.S. monetary policy has been way off track. The argument is it's been way too tight. I kid you not. Are you kidding me? The Fed has had zero interest rates for many years, all this balance sheet policy, but this argument says it's way too tight during the last several years. How could this be? The central bank can only do one thing in the medium to long run. It can control the price level. The aggregate price level is on target. So what's going on? The problem is the failure to adjust nominal GDP for this Reinhart-Rogoff effect. If you make the adjustment, it's going to look beautiful. So there's the picture. So what you do here is, yes, you have the price level picture that I showed you earlier. You have the real GDP picture that I showed you earlier, which has a GDP growing faster here but slower over here. And you put those together and you get nominal GDP, which puts real GDP and the price level together. And if you make the adjustment, now nominal GDP is right on target. So now you get the story that makes sense. The story is the price level is exactly on the path established by the U.S. since the mid-1990s, which passes the signature test of optimal monetary policy, makes us policymakers and the chairman in particular look very good. The real GDP, as I argued, is growing slowly because of this Reinhart-Rogoff effect. I haven't said too much about what exactly it is, but we know it's a regularity across 800 years of financial crises. And if you adjust nominal GDP for the Reinhart-Rogoff effect, it's also about on target. So the nominal GDP targeting story is not really any different from the price level targeting story, because you're right on target if you make the proper adjustment. All right, well, it's almost time for you guys to ask questions. I'll just mention a couple pieces of research I like. One of them is mine. I really like that one. One is by Athanasios Orphanides. He had a very influential paper that pointed out that in the early 70s in the U.S., policymakers misjudged the trend in real growth in the economy. They kept pressing too hard on monetary policy. What did we get out of the 1970s? Double-digit inflation and double-digit unemployment at the same time. So things really went haywire, and believe me, I know, I grew up in the 70s, and the music was bad as well. So the thing about Orphanides was that he said that all the problems in the 70s were caused by this idea that you didn't make proper adjustments for changes in trend in the real economy. You get monetary policy pushing too hard, then you just end up with a lot of inflation and a volatile real economy. That was the story of the 70s. I actually looked at a version with Stefano Giuseppe, who's at the New York Fed, on misperceived productivity slowdown, like the one talked about by Orphanides. In our paper, we did a little bit differently, but what we found was you could get about 300 basis points of extra inflation or too much inflation from the misperception of what was going on in the real economy. So the danger here for policymakers is that if you don't read the tea leaves right on what's going on the real side of the economy, you can be way off on your inflation response. So for naive nominal GDP targeting, which is just saying, oh, gee, nominal GDP is way below where we think it should be, without an appropriate adjustment, you might get very severe effects like the ones I found in my work with Stefano Giuseppe. All right, let me wrap up, and then we'll turn to some questions. So if you weren't paying attention, here's what the whole story in 5 bullet points. If you look at the simplest versions of a leading macroeconomic theory, it suggests that the price level path can provide a sort of signature for optimal monetary policy. If you look at the U.S. experience since the mid-1990s, seems to fit into this signature test. So at least on this very broad basis, looks like U.S. monetary policy is about optimal. Even though the economy was hit by a gigantic shock in 2008, price level path still stayed on target. Real GDP, however, has grown pretty slowly in recent years, and I'm saying this is due to the Reinhart-Rogoff effect. Nominal GDP is the combination of real GDP and the price level. It's also about on target if you properly adjust it for this Reinhart-Rogoff effect. If you didn't adjust it and just tried to take naive nominal GDP targeting, you could get a policy disaster out of that because you could get way more inflation than you were expecting. Price level would go off the established path, and it wouldn't be optimal monetary policy anymore. So that's my story. I'm sticking to it, and I appreciate you guys listening to me. I'm happy to answer questions about this or other questions that you might have about what's going on at the Federal Reserve. So thanks very much. And if you want to ask a question, we're going to embarrass you and make you come up to the microphone. No, you don't really have to, but no, you do. Come on. It's just so other people can hear the question.
Oh, okay. Hi, guys. So in the interest of the dual mandate, when you were discussing Sweden, they had a shift in structural unemployment. Is it your opinion that perhaps the United States is undergoing a similar shift? Or do you think that's an exaggeration of the current sluggish growth?
Yeah, I think that's been it's a great question. Is the U.S. undergoing structural change in the labor market? And there's been a lot of analysis of this of different types. I think the jury is still out on what we can say about this issue. One of the things that has happened that's been very significant in the last couple of years, all these people have left the labor force. I didn't really show that picture here, but labor force participation has been on this downward slide. So to me, what that's saying is that households are they're saying, given these wages out there and the skills I have, I'd rather stay home. So why is that happening? And what should policy do about it, and how much should they do about it? It's a big issue. On the structural, sort of the mismatch issue, I think one of the things that impresses me is that there's mismatch in the large. So you certainly have a tech sector, for instance, that's doing very well. Some of the tech firms have given like all their employees a 10% raise out of the blue because they're really competing for all these programmers and they're trying to get them to come to their firm. But the construction workers that were put out of business by the housing bust, they can't go up to Seattle and get the job at Microsoft. So I think in that sense, there's a mismatch in the large. So. Sure.
The other day in a fixed income class, we were discussing measures of inflation and their accuracy. I was maybe hoping you could speak more to your thoughts on the accuracy of whether it be CPI, PPI, or GDP deflator, any measure that the Fed uses to measure inflation.
Sure. So the question is how to measure inflation. Seems like it'd be easy. It's actually a very difficult thing. Because if you start thinking about it, you're talking about an economy, let's say $15 trillion economy. All these transactions are going on every day, millions and millions of transactions, and they're all at different prices, and then you have to wait how many units are being sold at the various prices. Plus, you have new goods coming in each year, other goods are exiting each year. By the time you try to do all of that together, that's actually quite a difficult problem. So with the Fed, there are different measures. One is the Consumer Price Index, which is one way to do it. Another is the Personal Consumption Expenditures Deflator. The Fed has said that we prefer the deflator because it has a little bit broader coverage, and that is our preferred measure. However, I do like to look at various measures of inflation, and I think if we're going to take a policy action, you should sort of have. I wouldn't want to do it just because one number said one thing. If all the other numbers are giving you a different signal, that would make me nervous. Also, the Fed likes to exclude food and energy when it talks about prices. I don't like to exclude food and energy, because those are prices that people actually have to pay. I think it's important for a lot of households, and maybe you guys, your main experience in markets is actually going to the grocery store and going to the gas station. That's your main interaction on a daily basis. So I think it hurts Fed credibility to say, we know that those prices are going up, but we don't care about those prices. So I think it's very important for the Fed to emphasize the overall price level over the medium term and not just the so-called core prices that throws out food and energy. You guys can come and line up too.
So I have two questions. The first one has to do with the most recent policy action. So it seems like the FOMC has taken a very dovish approach to everything. And what's kind of the plan if you start to see a tick up of inflation? Some would even say hyperinflation, but you still have continued high unemployment. Can you give us any insight into what the committee is thinking about that?
Yeah, that's a great question. So for those of you that weren't following this, the committee did make a big move at the last meeting. We decided to restart our quantitative easing program on top of our existing so-called maturity extension program. So it was fairly aggressive. Now, I liked some things about the way we did this because we did it in a way that's going to be a meeting-by-meeting approach. We said how many bonds we're going to buy between this meeting and the next meeting, as opposed to saying that we're going to buy this big chunk of bonds over a whole year or longer. I think that's a better approach, and it's more analogous to our normal interest rate policy. So in interest rate targeting world, which we can't do now because we're at zero, but in the interest rate targeting world, we would make a decision. We'd say, okay, we're going to go 25 basis points in one direction or the other direction, and then we're going to review the data in the next meeting, and then at that point we'll make a decision about whether we're going to go further or not. The committee often moved in the same direction in many meetings in a row, but we did it as a sequence of actions, not as one big action. So I think this will help us be able to react effectively to incoming data. I like that part of it. I have not liked these end dates on the programs. If you put calendar end dates on the program, then it's just the way the world always works, right? So the data, when you get to the end date and you're saying we're going to take this program away, then the data comes in and it's not looking very good. It's not actually a good time to be ending the program, but because you promised to end the program, it has to end at that moment. So I haven't liked that. I think it's put the committee in a bad position in previous years. Okay. What if we get some inflation? Now, the chairman has said we're going to take a balanced approach to our dual mandate. We have other language that says we're doing what we're doing in a context of price stability. So I think that is important. I do think that we have some room to maneuver right now in inflation. Inflation's down a little bit. Headline inflation, especially measured from a year ago, is not that high right now. Partly because of commodity prices, but as I just said, I think you should include those. So I think we have some room to maneuver. It's not like 2010, where in 2010 everything was pointing down and inflation expectations were down. So the answer is we're keeping an eye on it, and we're going to take a balanced approach.
Okay. And then the second question actually is kind of like the same thing, but so the Fed right now is, from some reports, purchasing about 60% of kind of new U.S. government-issued debt and 80% of agency debt, so that's Fannie, Freddie, Ginnie. So given this, what are you looking for the effectiveness of the new $40 billion program? And given another part of it is given how mortgage underwriting standards have increased and we haven't really seen as much loans going out despite lower rates, what do you target next?
So the effectiveness of the program?
Yeah, so essentially, how effective is the program going to be given that interest rates are at historic lows for home buyers, yet we're still not seeing a big boost?
Yeah, I think I'm one that thinks QE2, the second round, was effective. Mm-hmm. In that situation, most measures of inflation were declining, inflation expectations were declining, clearly turned around in the fall of 2010, moved back higher. So I think in that sense we were able to influence the inflation rate and the price level through the quantitative easing program. There has been some concern that there might be diminishing returns to these kinds of programs, so we'll have to keep an eye on that and see if that's what happens or not. But I've been one that has argued that quantitative easing has been effective. So,
okay, great, thank you.
Stick with that.
So I know one of the goals of QE3 was to reinflate the housing bubble a little bit, so that you can.
It was what?
To reinflate the housing bubble a little bit, get some of those homeowners at least so they're not underwater anymore with their mortgages. How do you decide how to strike that balance to prevent another housing bubble like the one that caused the crisis?
Yeah, no, it's a great question, and I would say, at least for me, the objective is definitely not to reinflate the housing bubble. I don't know, maybe others are saying that, but the housing bubble caused a lot of damage, and those were unsustainably high prices, unsustainable pace of production of houses, And we don't really want to go back into that situation again because it will crash again and it'll cause a lot of damage. So I would not want to reinflate the housing bubble. It's true that we bought mortgage-backed securities and we'd like to see the housing market do better, but seeing it do better is different than saying go back to the peak of the previous prices. And so I think the intent there is to get better performance in the housing market. And I will say also that 2012 has been, by recent standards, actually a better year for housing. Prices are up, housing starts are up. Everything's up from a very low level, so it's just a little bit of increase. But I think the housing market has ceased its decline, it's found a bottom, and it'll probably start improving, but only gradually going forward.
All right. Okay. Thank you. And in response to QE3, the other central banks, such as Japan, will also increase their money supply. So, is there any that will affect the U.S. economy recovery or not?
It's true that the Japanese central bank has continued and expanded a little bit its quantitative easing program. We saw the picture earlier, but as some of you know, Japan has had trouble keeping inflation at its target level. Their most recent target that they say is about 1%, but they haven't been able to get to that. I do think that a QE program in Japan might be able to restore the inflation rate in Japan to this target level, so we'll see if that occurs, and in that sense, I think it was a reasonable policy move for them to make. I have to be careful not to tell other central banks what to do.
Got time for one more question? Anyone has one?
Okay, I think we're questioning out. I really appreciate everyone coming tonight. Very attentive. I hope this was you learned a little bit. And please, by the way, we have lots of data at the St. Louis Fed. If you haven't taken Chris's class, then you don't know this. But if you are interested in looking at macroeconomic data, just Google FRED, or St. Louis Fed, FRED, Federal Reserve Economic Data. And you can graph to your heart's content all kinds of economic data. And if you need it for a class or something, it's very useful. So just put a plug in for that. All right, thanks a lot.